Yahoo Finance's special coverage of the February jobs report. I'm Julie Hyman. That's Miles Udland. We were just talking about the Jobs Day lockup and what is involved. We are not in, but we still get the information at the same time. We just don't get it early.
Well, someone's got it,
though.
Someone's got it. Someone who's doing broadcasts at somewhere else, they've got the number.
A bunch of someone's.
This is the other cool thing about the lockup is there's an interregnum where you know someone knows, but you don't know.
Yes.
Like that's what I liked with the Fed lockup. It's like there was a brief window when I knew something other people didn't know, and they would know it.
What I also enjoyed about the jobs lockup is that you have a BLS staffer there.
This is where it came from. You've done this.
With a phone.
Sure.
So if you have any questions, you have the paper copy of the jobs report. If you have any questions, the BLS staffer will get on the phone to the other staffers who have the answers to your questions.
Sure. You want to do what the expectations are here?
Yeah, I guess we might as well.
So we know what we're actually looking at here?
Yeah. We're looking at 55,000. That's the number that we're expecting for the overall non-farm payrolls number. Average hourly earnings, 0.3% is the gain we're looking for. Unemployment rate, 4.3%, which would be unchanged from January to February.
Yep.
But is there anything standing out to you that you are going to be zeroing in on in particular? Is it still all going to be healthcare jobs, for example?
We'll talk about that when we get through it. I've been surprised the extent to which in the last couple of months this conversation has come up where it's all about healthcare, and I was like, hasn't that been the case for 20 years? It's certainly been the case for the last 10, that the bulk of many job gains are coming just from healthcare, education, these services sorts of roles. So I think the way that got into the conversation the last couple of months, we can discuss that when the numbers come out. I think to me, the unemployment rate's the only thing that matters because really the jobs report matters in the context of the Fed, what would push the Fed to go one way or the other. And so long as it's kind of a weird one. I feel like as long as the unemployment rate doesn't go up, the Fed has the cover under Kevin Warsh in the future to then go in and cut rates because that's what they want to do. They want to cut rates, and they really just want there to not be massive changes in this situation so that they can go ahead and do that.
All
right, let's talk about it here. Negative 92. I was going to do the numbers, Julia. Okay, negative 92,000. So the U.S. economy lost 92,000 non-farm payroll jobs in the month of February. That is a massive surprise compared to the 55,000 jobs that were expected to be added to the economy last month. The unemployment rate goes up by 0.1% to 4.4%. That's up from 4.3% the prior month. Average hourly earnings up 0.4% month on month, 3.8% over last year. Both of those beat forecasts by 0.1%. But the headline here is the headline: 92,000 non-farm payroll jobs taken out of the economy in February, a massive surprise relative to the 55,000 that we were expecting to add. Last month's job gains revised to 126,000, so basically unchanged there. So we're now, what's my math here, Julie? We're up 30,000 jobs roughly for the year, which is right on pace with the number of jobs we added on average in 2025.
Yeah, although that headline number is a pretty...
it's a shocker.
It's a shocker.
It's a shocker. It's the biggest negative number I can remember, I think, since the pandemic.
Yeah, it is interesting that you have that average hourly earnings number ticking up a little bit. 0.4% was the gain there. If all you're watching is that unemployment rate, it going up 0.1% to 4.4% is not necessarily good news. By the way, we also just got retail sales, and they fell a little bit less than estimated. You're laughing at me because who cares about retail sales? But for
completion's sake.
Yes, exactly. That's your theme of the week, for completion's sake.
That's a crutch phrase I've been finding myself leaning on way too much. I gotta cleanse myself of that over the weekend.
All right, I'll make you put some money in the jar every time you say that. Let's look at futures, shall we? Because I want to see what the reaction is here to these numbers. We're seeing futures were already lower, by the way, as we have seen really. The thing that has been driving stocks this week up until today has been oil prices.
Overnight
oil prices crossed above $85 a barrel for WTI. This is a big deal. And it was a surprise, right? Because there wasn't necessarily any one thing that drove it higher to that level. It's just a cumulative effect of everything that's been going on with the Strait of Hormuz. So futures were already lower because of that tick up in oil prices. And so we're not really seeing much difference now that the jobs numbers have come out necessarily in the wake of those numbers.
No, we're not. All right, let's get on with our conversation here.
Let's do it.
We've got two folks sitting on either side of us that we, had been leaving out of frame here. Lauren Goodwin joins us from New York Life Investments economist and market strategist. Michael Reed joins us as well from RBC Capital Markets, head of U.S. economic research. Thanks to both of you for sitting patiently as we got through the numbers here. Lauren, I'll go to you first. Just initial reactions on the numbers, and I think just a surprise that we all kind of couldn't believe. We've got down almost 100,000 jobs.
Yeah, I hope my microphone was off, because when I saw that number, I went, ooh. Look, the market leading up to this number today was really hoping that this was going to be a nothing burger, and I think anticipating that whether a little weak or a little strong, that's what it would be. This is a challenging figure, and with a market that's been digesting risks related to stagflation, higher energy prices and inflation risk related to the war in Iran, certainly concerns about where the labor market might be going with respect to AI and the economic cycle. This is only going to reinforce those positions, and I see the 10-year yield already falling, suggesting to me that the concern that actually the economy is on weaker footing than we all thought just a few minutes ago is the price action of the day.
I'm also struck, Mike, by the fact that I don't think anybody had an estimate even near this low. I think I saw 35,000 was one of the lower end I saw. So, when you get a number like this, what happened here? Why? What do we miss? What did economists miss? What did we think was not accounted for?
Yeah, part of it, I think you have to dig into the details. Certainly when you think about construction, for example, weather's going to be a factor there. We did have some snowstorms that would weigh on things like residential as well as non-residential construction. I say non-residential because that's where you're really seeing a lot of the AI activity, if you will. On top of that, one thing we've been highlighting a lot, and I think something that needs to become more appreciated moving forward, is when you think about demographics in the US, retirements are a big story. We had record retirements last year in 2025 to the tune of 2 million workers. When you have workers retire, that subtracts from payrolls. So if you don't have that backfill hiring, that means you're going to start to see these numbers in terms of the payroll tick down.
I just want to give some of the details here. We were talking about healthcare before. There was a big Kaiser strike. Kaiser Permanente had a big strike, and that was expected to have an effect. So here's the effect that we had. Healthcare employment was down by 28,000. Physicians' offices down 37,000, and that was where the strike activity seemed to be concentrated. Hospitals added 12,000 jobs. So, that's something where obviously the strike is, well, I don't know about obviously, but the strike activity might not last.
It appears to have been.
Yeah, right. So we'll see if that lasts another month. Employment and information was down by 11,000. It's off by 5,000 jobs on average over the past year. Federal government employment was down by 10,000. So those were some of the places where we saw declines. Transportation and warehousing was down as well. So, there were a number of areas where you saw those declines, but the real pivot was that healthcare, which had been propping everything up, did not.
Well, I think, and coming back to, let's say, like the overall architecture of the labor market and getting a handle on it, Michael, in your note ahead of this report, you guys noted that this incorporates new annual adjustments to the household survey. Also, it made me think about, where are you and your team at in terms of trying to guesstimate or, estimate what that kind of break-even level of employment gain is in the economy? How much has that come down? How much do these adjustments impact that? Because, again, my second thought after seeing the headline number is that if you put January, February side by side, we're right back at that 15,000 job number we saw last year. Is that what you're thinking about for, the steady state employment number, or is that even a little below that?
That's about where we thought it would be for 2026.
Okay.
In 2025, we thought it was around 40,000 jobs per month to hold that unemployment rate steady. Following the QCW benchmark revisions for payrolls, that brought it down a little bit for us. So moving forward here in 2026, we do think it's close to flat to around 20,000 per month. And that factors in, again, the pace of retirements staying quite strong, as well as immigration, which has slowed notably. So without those two supply side factors really contributing to job growth, you have to get used to a new normal where you're going to see very little job creation. And that's not to say that there's not hiring underneath the surface.
Right.
I think it's a misnomer to say there's no hiring.
So how do you figure out what's demand and what's supply, Lauren, when you look at these numbers? I mean, not just this number, but in aggregate and what we might see the rest of the year?
Yeah, so I think the way that we think about this question is really to try and separate what might be cyclical factors related to, how is economic growth doing right now, which, the situation in Iran still unfolding. A lot of the leading indicators were suggesting that actually the economic cycle was doing very well, if not picking back up. The Chicago Business Barometer for February, just in the last couple of days, really showing actually a positive impulse for hiring, and separate those from the structural issues, changes in immigration policy, disruptions related to AI. These are really difficult things to estimate and to parse out. I think the Anthropic report that we all probably took a peek through this morning is a good example of how even data providers and economists are trying to adapt their models for these changes in supply and demand. So the answer to your question is we try to reset our expectations the way Michael's so elegantly putting out around what a good job number really looks like. I think even with lower expectations around the break-even job rate, this is a disappointing number, especially with the unemployment rate going up. Yeah,
and I guess every jobs report kind of brings back, to me at least, the eternal question, which is like, are you benchmarking to 1 month? How do you kind of parse out like any 1 month's number versus the overall story? But I guess to pick up on your last point, it doesn't really matter to an extent what that overall story is, how you're massaging it, how you're decomposing it. The market's kind of going to see negative 92,000 jobs lost in a single month, and that's going to set the tone, whether it's just for today or like that's the thing that's in the back of people's mind. And it, to me, maybe, and I don't know what your view is on this, it puts the economy and the markets in a you need to now prove me right situation again, whereas previously we kind of came into this feeling like the economy had earned the benefit of the doubt. And I think that might go away after this kind of a number.
I think that might be right, especially, again, there's a lot of nerves in the market right now about the real economy because this data has been difficult to read, because there are so many structural shifts related to geopolitics, immigration policy, trade policy that the market is digesting. The global backdrop has changed. And so the fact that we had, again, really quite a strong report last month with very few revisions actually to that report, which I'm making note of mentally, that does give the market the benefit of the doubt essentially on the economy. What I think we'll be dealing with now is an environment where concerns about, I think the R word, recession, is way too far of a step at this point, but concern that the ballast that the economy has against these structural shifts related to geopolitics and AI might be weaker than we thought. I'm not ready to go there on this report yet, but I think related to price action, in the spirit of your question, we are going to see some of that today.
Well, what I find interesting is, okay, so depending on when this report hit, you would get it and you would see yields come down and you would see stocks go up, maybe. That's not what's happening, right? So there's not, in other words, we're not in like a bad news is good news moment, at least not for the moment. And it seems like at least part of the reason for that is the oil prices and gasoline prices that are pushing higher. And I think we're all grappling with how much of an impact that's going to have, how marginal it's going to be. I mean, I keep hearing like it's not a problem maybe until we get more into the 90s. How are you thinking about that question? And like how much does that sort of cancel out any positivity from what lower rates might eventually yield?
Yeah, you're absolutely right. You have to think about what's going on, what's ahead. So as Lauren said, there's a lot of factors at play globally that are now weighing on businesses and consumers here in the US. When you think about oil moving higher, yes, it's a worry. And if that is a sustained price increase that we do see, if that starts to show up at the pump and consumers have to pull back on spending, that really is going to weigh on certain sectors that are already being impacted by tariffs. So you have uncertainty that was introduced last year. We had a little bit of a shakeup with the IEEPA overturn. We're now seeing that in a new being implemented in a new way with new tariffs. And now you're layering on these geopolitical events. So when you think about global trade, that's going to continue to weigh on volumes. That tends to correlate very highly with things like trade, transportation, employment in the US. And then if you see consumers pull back, that's going to weigh on retail trade, as well as a variety of other services, as well as leisure and hospitality. I would highlight leisure and hospitality is probably the one we're focused most on. That's really indicative of discretionary spending, a very strong indicator for those higher income folks. And if those folks start to pull back on spending, that's where we become more concerned about the consumption growth here in the US, which has really held up for most of 2025 throughout all of this uncertainty.
Right.
So you mentioned it, and obviously jobs report just breaks, but a lot of other things in the air that while I have you two, I'd like to get to. So Michael, you mentioned the IEEPA tariffs and the headline we saw yesterday on these possible rebates, and it just has me thinking about one, this whole new world we're in where people now get checks, State Farm is sending checks to people, and how that money tends to feed into the economy. And if you and your group are looking at any amount of this rebate to consumers or money that could come back into the economy, which may come in at the consumption level, and how that feeds into GDP, back to this idea of, are we going to have to, as a, let's say, markets collective, get comfortable with the idea that the labor market looks pretty meh, but the growth data is actually solid, if not improving?
My one concern this year is that you are seeing a lot of signs of weakness in the lower and middle income cohorts. And there, when you think about things like credit card delinquencies, auto loan delinquencies, you have student loans weighing on those consumers. Mm-hmm. We expect a lot of that type of, whether it's rebates or tax refunds that are coming out in April, we think a lot of that money will likely flow to kind of paying down that debt. So it's not necessarily going to drive consumption. Also, when we think about that top 10% of income earners, those folks who are really driving consumption, our concern too is that when they get these outsized rebates, and in fact, when you look at the One Big Beautiful Bill Act, how that disproportionately benefits that income cohort, they had a big pull forward of consumption in 2025. Their saving rate for that cohort dropped by about half. So we think there may be kind of this restocking of savings and not necessarily money that is going to go into the economy and be spent on consumption.
So that sort of implies, Lauren, that, first of all, do you share Mike's view? And secondly, that would imply that the upper income cohort sort of propping up and propelling growth, maybe that engine loses a little steam.
Yeah, I'm sympathetic to Michael's view, and actually I would view it in many ways actually as an optimistic view for the economy as a whole. Maybe not for the growth rate per se, because the consumption, which is about 70% of US GDP, would be moving on the aggregate a bit lower, but bolstering the cycle to last longer effectively. If you have consumers deleveraging, that in a lot of ways would be healthy for the economy. The thing that I would say I'm more concerned about is the fact that so much more of US spending has started to aggregate with the upper income consumers. What that effectively does is it ties market outcomes to the real economy, because these are folks that are on average more invested, that have more of their income moving into effectively wealth over time, and that have benefited from the meaningful move up in markets over the last couple of years. And that means if you get a 10% correction, a 15% correction, which compared to what we've had over the last couple of years, frankly, it probably wouldn't end anybody's financial well-being, that results in a pullback in spending in a way that essentially links the markets and economy more closely.
And thinking about that as well, and maybe we'll finish here just on the AI labor market question, because you noted probably not going to see it in this report, might not see it for some time, but as we're discussing this upper income cohort, that's going to be more often a white collar workforce, which on the margins may be more exposed to some of these AI layoffs, and one wonders if again you can get in a situation where you have aggregate spending, it looks okay. Aggregate payrolls, they look okay. But we're talking about households, 200 to 300,000 in income that now on the margins feel a little, the LinkedIn labor market feels a little less dynamic than maybe it did, a couple of years ago.
Yeah, people feel less secure, right? I certainly read that report this morning and read essentially a line of demographic facts that matched me, and you start to
I read that also, yes.
But I think that the really important point that can tie this to the markets is that we have seen especially over the last couple of weeks, the market really start to ask this question of when do we see the labor market implications, the sector implications of AI? The answer is none of us know, and that none of us includes the Fed. So when you have these inflation concerns related to energy prices, tariffs, even an overheating economy, which again was much more of a conversation probably 30 minutes ago than now, weighed against concerns about the labor market, the fact that there's so much uncertainty on both, that's really where I anticipate the Fed will be focused in these upcoming conversations.
And by the way, the paragraph that Lauren was referring to from that report, from the Anthropic report, workers in the most exposed professions are more likely to be older, female, more educated, and higher paid. So yes, I felt attacked a little bit by reading that part of the report. So Mike, how are you thinking about the AI question? I mean, and what I found interesting in that graph, and I encourage everyone to look at it, Anthropic published this thing publicly, they have like sort of this wheel, if you will, and they have different colors for areas that could be disrupted by AI, but the part that actually is already being disrupted is very small. And we don't know how or with what pace that is going to grow to be bigger part of the wheel.
Yeah, you're absolutely right. And as Lauren said, we don't know yet how AI is really going to impact the labor market. I think it's very easy to model it out right now and talk about which jobs, which sectors may be most at risk. But as we're seeing it right now, the adoption rate and full implementation of AI as a productivity tool is still very early. So the boost we're seeing in terms of growth right now still very much involves the infrastructure behind that. So that will provide a tailwind right now. That broader kind of job destruction that we all talk and worry about, I think that is something that is further out, but still something that very much should be on our minds because once it does start to get some momentum and start to help replace some jobs. The question is, what else is going on in the economy at that time? Right. Will we be seeing retirements at the same pace? Will we see immigration still very low? Because that supply side factor will be a big component of how that impacts things like the unemployment rate.
Do you have a preferred LLM tool?
I probably am not the best person to base it off of, but I use ChatGPT hourly.
There you go.
Yeah,
okay.
Mike, do you have one?
We have an internal tool at RBC, so
see?
we're very.
We haven't replaced the workers yet. We had to build an internal tool.
Well, by the way, today I learned that Anthropic employs economists who wrote this report.
Yeah.
Although I did, of course, wonder how much they used Claude to write the report.
Yeah.
Or entirely. Who knows? I don't know. Lauren, Michael, thank you so much. Great to see you guys.
Thanks for having me.
Coming up, we're going to have more on the jobs report. We're going to really dig into the market reaction next. All right, we just had a jobs report that showed a big disappointment with the drop of 92,000 jobs in February. Let's find out really how it's percolating through the markets this morning. Jared, what's going on?
Well, thank you, Julie. The immediate reaction was risk off, but as we see a lot of times with these jobs reports, sometimes we get reversals. Haven't seen one yet. I'm looking at the Dow Jones Industrial Futures, and we can see they are at the lows of the day right here. And so far, we're down about 1.2% overnight. Let me just show you the 5-day price action here. So this is going to show you we are at the lows of the week. By contrast, the NASDAQ is down 1.5%, but you can see over the same time frame, it is not hitting those lows that we saw Tuesday. It has been relatively an outperformer this week for the most part. The Dow really got hit yesterday. And then here's the S&P 500. This is America's benchmark index, and we can see it's trading around 6750. My thesis all week long has been you got to watch the 6800 level. It's longer term support, and we've been dipping below it. So once again, we'll see if we can eke out a close above it, which we've been doing this week. But so far, the movement has been down, and we haven't seen any kind of reversal. Of course, we have several more hours until the close today. So let's take a look at 2-year U.S. Treasury note futures, and here we can see that the immediate reaction was to the upside, but then we retraced. So we're kind of back down to where we were when the report was dropped, and I can show you what this looks like in the 10-year, and so this is going to be opposite. Yields were going down here, and then here's the 30-year yield. You can see it's down a basis point, 4.74%, and then over the last 5 days, it's been really interesting to watch yields kind of climb up. That means bonds have been sold, so there has not been that flight to quality bid in treasuries that we typically see with a lot of these geopolitical events. And so that just tells you that a lot of these require, there's not always a playbook for these events. So let's also take a look at what's happening in the VIX. And we have seen that elevated, but certainly not at panic levels. It never even approached 30. I think we got to about 28 and change. So got kind of close, but right now we're trading at 26.3. And in the long term, I'm going to put a 1-year chart. You can see we've had some bigger spikes. Here is what we saw last April. That was all the way up to 60, I think, on an intraday basis or thereabouts. And so we haven't really seen volatility enter the market, that kind of panic fear just yet. Also want to cover what's going on in the US dollar index because this is a 1-year chart. Let me just dial this down to a 5-day. You can see it's been elevated all week. So another market I've been keeping track of here, US dollar index, you don't want to see that above 100 because that would trigger a lot more tighter financial conditions. With the rise in crude oil, which is priced in dollars mostly globally, when you have higher prices, there is a movement to buy dollars so they can pay those higher oil prices. So let's check out what oil is doing right now. Didn't really get much of a reaction. You don't expect to see a reaction off of this report. It's operating off of its own fundamentals, but you can see it is up about 23% this week. That is more than we saw in March of 22 in the initial run-up after that invasion by Russia into Ukraine. So we are back at 2020 levels, and that's something to think about there. So let's check out with the sector action. First, I'm going to show you what happened this week. Energy, not a surprise. That is a green. That's up 1%. So is tech. So communication services, just barely green there. But what has not worked this week? Staples, materials, healthcare. Those are all down 4 to 5%. And staples is one of the best performing sectors this year, but has not been that flight to safety trade. So it's been very difficult to parse out the winners and losers so far, but we do have those key levels that we'll be keeping in mind. Back to you, Julie.
All right, Jared Blickery with a look at the markets there. Coming up on the other side, in the background of this week's action with oil, Iran, AI, as Jared was discussing there, we've had a lot of news on the retail front. Simeon Siegel's going to stop by from Guggenheim to talk about all of that right for this.
is Yahoo Finance Morning Brief. It's Friday, March 6th. I'm Julie Hyman. That's Miles Udland across the desk from me. Yes, we had a jobs report a half hour ago. It came in quite disappointing. Yes, futures are down, but we want to take a little breather. We want to take a little pause, not to talk about. We'll get back to jobs. We want to talk about what's going on with the consumer, because I think that the jobs report is also quite relevant to that. And the other headline this morning of oil at $85 a barrel is also relevant to that. To talk about all this, Simeon Siegel's joining us, Guggenheim Securities Senior Managing Director. Simeon, fantastic to see you again. Good to have you with us. I want to start with oil prices, because we've got that sort of eye-popping $85 a barrel this morning. $100 is out in the ether being discussed. And I think, initially there was sort of this shrugging off of like, most people aren't going to care that much about these higher oil prices. It's not that much of an increase. But already, we're not even a week in and we're seeing $85. So how are you thinking about that and how that's going to maybe affect discretionary spending?
First of all, great to see you. Great to be back. It's been a long time, so I'm glad to be here on a nice Friday. I was listening to what you guys were saying before, and I'm hearing all this like Armageddon, all this negative news, and then we're going to bring on Simeon, and he's going to be so optimistic. I'm like, I get to be like the Santa Claus guy over here. No, so I think, and Julie, you and I have talked about this before. Oil is this interesting dynamic, because oil is the first thing, and gas specifically, right, is one of the things we get to see, but doesn't necessarily move as much of the needle in terms of just disposable income, in terms of what's being spent. And so it's a very easy indicator. What I like to do, and when I like to do, is look at revenues. And what's fascinating, and I'm like right smack in the middle of my earnings. I mean, this has been a very interesting few weeks. What I can tell you is, by and large, and this is, again, backwards looking because it's Q4 earnings, so we're getting a view on holiday, revenues are skyrocketing. Revenues on average for the broader consumer group, even beyond my coverage, are up 7, 8, 9%. And that is a lot to do with tariffs. A lot of that is price, but people are still spending, right? Whatever the reason, people are willing to spend that 7, 8, 9%. Now, we can come back, and the flip side of that can be gross margin actually looks very different and looks down for the first time in a while. So that also has to do with tariffs. But I think right now, the future in terms of what we see, like we talk about how the US consumer, healthily or not, is overly resilient. And at some point, you have to say, when does that stop? It hasn't stopped yet.
Simeon, I was going to ask, and maybe you just got to it, so maybe I'll have to go to question 2, but just what's the most interesting thing that's happening in your coverage world right now? And so maybe it is those consumption patterns of revenue. Maybe it's a style thing, thinking about specific parts of the apparel and consumer stack. But I'm just curious what to you right now, like, kind of has you and your team going.
Can I just say something really quick?
Julie's got a second question.
Really quick here. I just love that, like, skyrocketing revenues in retail is 7, 8, 9%. I just find, like, all the stuff that
come on.
No, I mean, it's
that's such a great number.
It is for retail. It's all relative. That's all I'm saying. And so, like, to hear you say that's skyrocketing, it's great.
You know what's fascinating? If you look at the stocks that went down, and like, there's this always fun thing between fundamentals, business versus stocks. A lot of the stocks that went down are the ones putting up the biggest revenue growth. And so within my world. So if you think about, like, On Running just reported, they guided next year to grow 23%. I don't know if that covers does that work as being a lot? Is 23 enough?
Yeah, 23 is legitimately a lot.
Okay. So pull that stock chart up, that 23% constant currency number took the stock down a lot. And so there's this interesting dynamic. And again, like, you think about the hyperscalers and you think about everything else. So like, these big numbers all of a sudden aren't big enough. Some of the small numbers might be better than feared. So I think this all relative there, but I hear your point. But I will take, in a world where retail has been honestly, generally speaking, right? There's been a few exceptions in different points in time, but generally deflationary. Since 2008, the three of us could get whatever product we wanted at whatever discount we wanted if we were just willing to wait long enough. I mean, that's been the story of discretionary retail. And now we're getting this inflation. And so I think a big question will be, how long does it last? And I think the big question will be, again, obviously tariffs are a moving piece. But I think the macro stuff that's been so negative, which has been so negative for a while, that hasn't impeded the US consumer going out and spending on discretionary, specifically over a holiday period. Now, Miles asked about style. I'm wearing like blue against purple here, so I'm probably not the right person to ask about style. But I think in terms of really interesting dynamics from earnings, yeah, I think like that revenue piece, if we were to go out and take a straw poll, I don't think people would assume these businesses are growing year over year, high single digits, maybe even low double. In On's case, 23%. I think people feel that things are much worse than the revenues are suggesting they actually are. And so that was a very, very interesting takeaway so far from earnings. I think the second thing is what I was alluding to before about the difference between stocks and businesses. And you're seeing businesses like On Running, like Birkenstock, like these businesses that are putting up nice double-digit revenue numbers. Those are the ones that are actually being punished.
So let's stay on, and I want to stay on footwear, which is something that we've talked about over many years, and something that we had a discussion here of like, is footwear more of a men's thing now than a women's thing? Maybe we can table that for later. But I get on the train every morning, and it's just Ons, and it's Hoka's, and they're the dad shoes everywhere. And in the summer, all the women on the train have Birkenstocks, and I'm just curious about how those styles are feeding into, let's say, the overall spend. And I'm thinking now about some of the major incumbents, the Nikes of the world and the Adidas, and like, these are not really the brands that I see people reaching towards. And the stock story is one thing, but I'm kind of surprised at the relentless growth, the relentless rise on a trend basis of these brands that, frankly started as like technical running shoes and are now Gorpcore, it's all style, whatever you want to say. Salomon, is in that mix, and so on and so forth.
So I think you bring up a really interesting point that there's some brands that have emerged and hit a really nice escape velocity, whether the public companies you mentioned, whether on the athleisure side, we're hearing about Aloe and Viore a lot. Like, there's a lot of different companies that are now doing above $1 billion in revenue, which, again, I know for Julie, that's not that large. But for retail, that's a big deal. So we're gonna say that that's a nice escape velocity. But
I'm happy with $1 billion. So.
What's cooler than $1 million?
Yeah.
But I think that what we have to remember, and this is really important, is, and I'm right there with you, right? But the Venn diagram of people we see versus the Venn diagram of the TAM, the actual addressable market these companies are going after, the New York subway is not a great view of that. And so, and we, Miles, I think you and I talked about this with like Peloton back in the day. Right?
Yeah,
Peloton got to 25%.
Quote unquote, everyone had a Peloton, but not actually. Yeah.
Right.
Yeah, and like everyone's like, oh, I saw 4 vans driving down. Right. Like there's 4 different deliveries down my block. Must be there on everybody's block. But the problem was the Venn diagram people that own Pelotons and that invest in Pelotons was one circle. And so we all extrapolate. And so I think what we have to remember is On is doing a beautiful job at growing. Hoka has done a beautiful job at growing. New Balance, ASICS, like all these companies are really growing. Nike, the company that everyone is assuming is donating all this share, and Nike, the company that can't do anything right, Nike, the company that has no brand equity anymore, did $47 billion of revenue the year that people thought they were dying, right? That number is growing now. North America was up 9% last quarter. And so I think we do have to remember, and this is my point about revenues, the beauty of retail is that we have our own anecdotal biases. Everyone is a consumer. I mean, I can tell you, like you mentioned Birkenstock, like I'm wearing a pair right now, and if I'm not going to show them, but I'm just trust me on it. And so I think that there is a dynamic here where we can feel how big business is, but the only measure of how big they actually are, ready for it, drum roll, is how big they actually are. It's their revenues. And so the interesting thing with retail is, unlike these hyperscalers, unlike SaaS businesses that have recurring revenue that start every year at the same place and give or take, these businesses start from zero every year. That $47 billion in Nike's worst year, they still started at zero and sold $47 billion. Right. And so I think that's this important dynamic where at the end of the day, the brands tell us how big they are. And again, different than a stock conversation here for a second, but Nike's doing just fine. And then on top of this, what I would say is they have their answer to Hoka, right? I don't know if you've tried the Vomero, but it's one of the most comfortable things I've ever put on. And so their response, it takes time, but they have a big R&D budget to get you that dad shoe.
Simeon, are you rocking Boston's or are you an Arizona guy?
No, so you know what? I actually, for Hanukkah, got a pair of Kyotos, which is a little bit more like slipper-esque. So again, I'm trying to, Miles wants to know the style, but
I mean, I have Arizonas for the summer, but yeah.
Yeah.
I'm currently wearing Solomon's, in case anyone was asking.
Feel free to show it on camera, to bring that to
No feet on camera, Julie.
No feet on camera?
No feet on camera.
Okay, I'm being overruled.
I'm not that flexible either, so.
But Simeon, so I want to ask you, for lack of a better word, about the coolness cycle. Because I think what struck me about Nike for so many years is how cool it remained for so long. And that felt unusual, right? Like the dunk cycle. The kids were just like, and it lasted a long time. And Nike overall just kept kept hot for so long, or cool, depending on what you want to say. So I'm just curious, has that changed the paradigm? Like, how long can Hokas remain cool? How long can ONs remain cool? Or have those timelines shifted over time?
Yeah, and so listen, to your point, size is the enemy of cool, right? That's generally the approach. We know that from second grade. Too much of something makes it less cool. We've talked about before, my team's done, so thank you to my team, has done some phenomenal research around where brands peak. And I'm going to say this, you're going to say, wait, didn't he just say Nike was 47? So Nike is the wild exclusion, and they are the exception to this.
Right.
$3 to $4 billion in the US is generally where brands lose that cool factor. They go a little higher. We've talked about it with Lulu for years. That has been our concern with Lulu. Lulu's a great brand, but an overstretched brand, and now we're seeing it come back. But that's generally the level where I used to call it brand peak. It's the wrong word. It's brand saturation. That's where all of a sudden there's generally too much of what we have found. Now, again, this is a little technical, but it's retail sales. It's not like if you look at the company reports, there's a wholesale dynamic. So just what the consumer buys, when the consumer sees and spends the equivalent of $3 to $4 billion in the US, generally we have seen that as being a healthy level. They then stretch higher and come back down. And so I don't think that's changed. So then, okay, so then you come back and say, well, then why is Nike so much larger? I think, and I know, they have segmented better than anyone. And so the magic of what Nike has done, to your point, Julie, is they have a stable. I think maybe they're a portfolio of brands. They have the Dunks, they have the Jordans. They also have a whole, this idea of a signature shoe means they literally have different logos for different products. And so effectively you have this kind of, again, I don't mean this literally, but a portfolio of brands where someone who buys into what they want doesn't necessarily feel that it's overextended when they see a $50 pair of Nike running shoes that someone picks up at a discounter for back to school. And I think that is a very hard thing to do, but they were able to do it. I think that as the other brands stretch in, they're going to have to figure out, how do you stay true to who you are? How do you make sure you don't stretch beyond, again, I would say a revenue size, but it's also a revenue approach. It's trying to be everything to everyone. Under Armour obviously fell prey to this a long time ago. And the question is, can they reverse course?
You know, Simeon, thinking about the stocks, I know you're in the middle of earnings season, so you got, big moves in stocks based on these distinct news events. But I'm just curious, in your conversations, with your team and then talking to clients about your work, like, what has your coverage universe, how has it gotten or not gotten pushed around by some of these, let's just say, macro cross currents that are happening? And I don't mean what's happened this week. I mean the AI trade. I mean, are people calling apparel names SaaS companies now? Like, what has the stock action been like, and how that's impacted, and we all know that price can then create a narrative around the fundamentals, even if it hasn't shown up. So just within that area, how you've had to navigate that the last few months.
Yeah, it's an excellent question because there's so many different macro pieces. I generally try to be micro focused because I think at the end of the day, good operators are supposed to do well in any environment. I think during COVID, it was a great environment, ironically, but it was a great environment for retail. So everyone did well. You didn't know who was a good operator. It's on the other side when you find out who's actually strong. So when things are tough, you find out who's good. So I believe that in any environment, you will have winners, you will have losers. And I think that's true in any subsector. I think if we looked at who just reported, you could see this fragmentation in luxury. You could see the fragmentation in big box retail. Like, it goes across the gamut. There are companies growing sales and companies declining. So with that said, that is my general approach, and I try to stick to that. Yeah, the macro has been a huge thing. And to your point, you have these huge ideas of AI. Is agentic commerce going to take over? Are we not going to go to stores anymore? We're just going to type in, find me an orange Nike shirt. I don't think the answer is yes, but people are wondering, and what does that do? But I would tell you, we all had this conversation about online originally as well. And by the way, stores are still the vast majority of these businesses. And so I generally think that a lot of these things end up being buzzwords more than they end up being revolutionary. But what you want to do is you want to figure out how to incorporate it. AI as a tool rather than AI as an identity is very important if you're running a retailer right now. Whether that's inventory management, whether that's CRM, whether that's, hopefully it's not yet designed, but who knows. But so there's a lot of aspects there where the same way that D2C was a channel, it was a way to distribute product, but it became company's identity, and that was the problem. I think when companies start talking about it as an identity, we need to take a breather and say, wait a minute, you're selling sweaters. And so that's, I think, the first part. But the second part of your question, which I think is really also important, is, and you didn't necessarily mean it this way, but I think it was phrased perfectly, it literally is by the week. Because imagine if you spent all of your time, if you're a company, you spent all of your time prepping what you were going to say on earnings. Yeah. The number one thing impacting a lot of these companies is tariffs. Right. And then all of a sudden last week, it changes. Yeah. Do you scrap your whole year plan? Probably not. Right? Are you ready to talk about it? Probably not. Are annoying people like me going to ask about it? You bet. And so you have to deal with this. It is very touch and go. And I think that's why from an operating perspective, I think what you want to do is you want to have your plan. You have multiple of them. You know which one you're going to pull depending on what happens. When dealing with the investors, I think what we have to do is we have to say, okay, here's the worst case. Here's the best case. Let's figure out a probability and figure out where we want to be in between.
And maybe this is too inside baseball, Simeon, but like I think on this call at least, we have an idea of how much prep from management teams goes into the earnings call and how they've all signed off on the messaging. And do you as an analyst, when you know that some event has happened, that now they have to go quote unquote off script, do you get any sense of like how this team might operate just their day-to-day business based on how you feel like they adjusted to, as you said, the question that you feel like you have to ask given some kind of current event that may have come up around the call?
I think it's such a great insight. I think that we're all people, right? And so whether we're journalists or analysts or operators, we prep for something. Like I didn't plan on telling you what I was wearing on my feet right now. It just happens. And so I think you prep for something thinking, okay, I remember that 7, 8, 9% is a number I should probably throw out vis-a-vis revenues. And then you ask me another question that says, hey, maybe Simeon actually likes Birkenstocks.
Well, you didn't think Julie was going to dump on that number either, you know?
No, I know Julie well. I knew it. I was teeing her up to just kind of. So, but I think you're absolutely right that you learn a lot about what someone's really thinking when you force them to answer a question that they didn't prepare for. And so I don't mean that in a mean way. I just mean to your point. It's like, you hear how there's a very prescribed, recognizing the amount of times my report is going to say beat and low and then guided below. Obviously, there's a dynamic in earnings where the companies want to underpromise and overdeliver, which somewhat by definition means the guidance they're giving us publicly is not really their plan.
Right.
And so anytime you can figure out what you believe their plan to be, you're going to be better off, worse off. You're going to have more information. And so I think it's a really astute and interesting point that you bring up.
So Simeon, let's talk about a test case then for that, which is Gap, which just reported and was asked about the tariff question. And as far as I could tell, kind of said, we're not accounting for that yet. Was that was that your sense? And what was the subtext, do you think?
I think the best answer, listen, if you threw it at me, right, not at the Gap, and you said, okay, what's happening with tariffs? I would probably start figuring out a way that I could give you an excuse and talk about my shoes again, right? Like who knows the answer was going to be right now? And so I can't begrudge them that. And so I think if I'm them, what I do is I tell all about my fundamental operating strength, which they believe in, right? They're telling this great story, the narrative is reversed, all of that. And then you say, here's what the pressure will be based on 2 weeks ago. Here's what we planned. We're going to have 150 to 250 basis points of tariff pressure. Okay, great. Now, should things change, there's obviously going to be upside, but we don't know how to characterize that right now. We don't know how to probability weight that for you right now. And so what we're going to tell you is take your gross margins, think about 150, 200 basis points of pressure, 200 from tariffs, maybe some benefit on the other end, and we'll go from there, and then hopefully we can obviously better or under promise and then over deliver, then vice versa. And so I think that's what they were saying. Now I will tell you, I do believe most companies, I'm going to have to adjust my numbers, right? I mean, so as companies tell us, we do need to change numbers, but I think we are giving a general pass for this level of uncertainty vis-a-vis tariffs right now. Because what you're not seeing is you're not seeing all these companies explode up thinking, oh my God, tariff is going to be so much better than we think. And so I think there's an element there of we're all playing this dance right now.
I am, just real quick on Gap, I am curious if you believe in that turn. I think you're neutral rated on it. So that implies you don't necessarily believe in the turnaround story quite yet.
Or that the stock is fairly valued, right? So I think that Richard and team have done a phenomenal job at storytelling, at telling us, obviously we've all seen the ads that bring us back to Mickey Drexler days, right? The fact that we all can think about Mellow Yellow, we can think about everything that they did, and then it hasn't happened in the last several decades is really interesting. So the campaigns they're doing now seem to be speaking and doing exactly what they should be doing, and we're seeing the comp. I think right now, what we're going to have to figure out goes back to going full circle, goes back to your point of A, did the stock already appreciate that? But then B, what happens to the consumer, right? What happens as we roll forward? What happens if tariffs, the interesting dynamic which we didn't talk about is if tariffs do change. I told you that revenue number, a lot of it came from companies' ability to raise price. Does that go back? Do companies give it back? And so I think there are a lot of dynamics. There's going to be a lot of tug of war. And I think that the Gap had seen a benefit. I think that they're not a business that people have been knocking down and saying there's no chance. And so from a stock perspective, that's been holding us on the side.
All right, next time, field trip to the Short Hills Mall, Italy lunch. We could visit the Arc'teryx store.
I'm
the
totally,
Aritzia in the Short Hills Mall, by the way.
We're locals
control.
to the Short Hills Mall, is what. But it would require quite a drive for Simeon. But he would do it for us.
We can meet Garden State, meet halfway.
Okay. No?
He'll come all the way.
Wow, that was quick.
He's coming all the way. No, I know. Come on.
Look,
All
these Jersey people are like really particular about their exits.
This is true, actually. All right, Simeon, thanks a lot.
All right, Simeon, appreciate it.
See you.
Great
All
to
right,
see you guys. Have a great weekend.
You too. Coming up, we're going to dig into the jobs report and the market reaction a little bit more. We'll be right back. The February jobs report, we're still seeing market reaction kind of try and make sense of it with the 92,000 job loss last month. Economists were looking for 55,000 gain on average. The unemployment rate ticked higher to 4.4%. I'm taking a look at the Wi-Fi Interactive to see what the market reaction is. The futures, took a leg lower. They remain lower. What I'm really interested in, here's S&P futures. Here's the 10-year Treasury future. So this is price that it's measuring, directionally. This more gives us direction. So price lower, yield higher. So initially we saw yields go lower, which you would expect, but now yields higher, which is a little bit interesting and maybe has more to do with what's going on perhaps with oil prices than which oil prices we are now seeing above $88 a barrel for WTI, which is pretty extraordinary.
I think that's, to use the cool markets phrase, that's probably the marginal bid in the market right now. I mean,
Yeah.
of like what's pushing things around. I mean, I think where I will take into the weekend is what Michael Reed from RBC, who joined us earlier, was talking about, which is the idea that break-even employment, aka the level of job gains that keep things flat, as it were, in the labor market, is probably around 15,000, which is what we've averaged so far this year and what we average in 2025. And like we all maybe need to get used to a new normal of that's roughly how many jobs you're going to gain or lose over rolling periods, which is very different than the environment we were in, not just coming out of COVID, but like the whole decade coming out of the financial crisis too.
Yeah, that's kind of a bummer to go out on into the weekend, in a way.
Is it?
Although he didn't, I mean.
I think it's just like, I think it's like, hey, here's a reset.
Yes.
You know?
Yeah, it is a reset, but it's a reset. I mean, and I guess
It's a reset lower. Yeah,
that
it's a reset
people have
lower.
already been experiencing, right? And, and I was also struck. I mean, both he and Lauren Goodwin, they're not pessimistic about the economy, right? They're, in general, market participants and economists seem to think the backdrop is okay. With, of course, the big swing factor now being oil prices and how long they stay at this level. But, generally the vibes among the people who are watching the markets are okay. They might be terrible for everybody.
Well, and
everybody
that's the
else.
other thing, and Lauren brought this up, and I haven't been able to make it happen yet, but I really want people to catch on to the idea of the LinkedIn labor market, which is
I noticed that phrase. I
white-collar
liked it.
workers who are like six-figure plus with some education.
Yeah.
You go on LinkedIn, so it's not good right now,
Right.
let's just say.
Yeah.
And it's far worse than these headline numbers seem.
So is that a real indicator, or is that not?
Well, I don't know.
Is it like
I don't know
is it
what
like
to say
everybody
about
on my
it.
block has a Peloton, so Peloton must be doing
If you
great.
want to go on a negative note, we'll go with that one. So, all right.
All right. Well, on that note, happy Friday. Have a great weekend, everybody. I'll be back at 10 a.m.
It's Jobs Report Day in America. I am coming to you live from Yahoo Finance's New York City headquarters studios. Here's what's on my mind right now. I'm just going to say it. I think AI agents are starting to steal jobs away from living, breathing humans. The headline Jobs Report showed a shocking decrease of 92,000. And yeah, the weather sucked in the country last month, but underneath it all, AI is laughing in the face of many workers as it takes their paychecks from them. To this point, the information sector lost 11,000 jobs in the month as tech jobs persist. Tell me I'm wrong. Tell it to me. The day after getting punched in the face, I told you on Thursday to stay fixated on headlines coming from the Middle East as they could hammer the market again. That, in effect, happened. Allow me to dust myself off. I think it's rinse and repeat with that playbook into the weekend, even if this awful jobs report raises the prospects of interest rate cuts. Shout out Alan Greenspan. You are 100 years old today. That is awesome. And speaking of jobs, a quick follow-up to a story I went off on yesterday. I've heard from a lot of you following my viral post on X, hammering 4 young finance vest-wearing bros for showing off luxury watches and suits in a magazine photo shoot. The verdict from these interactions, you guessed it, you all agree with me, and in particular are not feeling the pouty-lipped Goldman Sachs analyst Mason Clark. A lot of you would like to see him fired, while others, well, I can't repeat on here what you actually wrote me. Goldman Sachs PR conveniently got back to me after my show with a statement they cut and pasted to other media outlets. The team working hard over there, clearly. Perhaps they are too busy shopping for a new Rolex or the next sushi dinner. Here are my opening bid roundtable. Tom Essay, Simmons Report research founder, alongside Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. I mean, Tom, you acted like that when you started on the street, right?
Yeah, not so much. I would have been terrified to do something like that and then show up to work on Monday. But, you know, that was a long time ago, and it's definitely a little bit of culture. But I think there's probably a lesson to be learned in this for those young people, and hopefully they learn it.
Well, I will not. I will keep it moving here because it's a big day for markets. We're seeing the markets under pressure after that really horrific jobs report, Tom. What are the lessons to be learned after a report like this?
So everybody's sort of making the assumption that the economy is fine, and I get it. Most of the data is showing pretty solid growth. But the reality is that we are still in a labor market that's a bit in flux. Now, I don't think the negative 92,000 number is necessarily exactly correct. I think that there was a strike that added 1,000, and then the weather did have some sort of impact. But the reality is we are in a no hire, no fire labor market. And that's fine as long as it's stable. But if all of a sudden it can quickly go to a firing and layoff labor market, then we have an economic problem. And that is exactly what we do not need, given all the other headaches we have.
Brooke, you've been picking apart this report. You've probably heard me in the open. I think AI is starting to take jobs, but prove me wrong. What'd you see in the report?
I mean, what we did here was certainly the impact on unemployment when it comes to young people, to the impact of AI. If you take a closer look at the report, we did see information services. That was a sector that lost about 11,000 jobs. And that's part of a larger trend that we've been seeing over the past year. Even Challenger Gray and Christmas pointing out in their data, their report yesterday, the impact of AI on about 4,700 jobs in the month of February alone. We've also heard from multiple different companies, including Amazon and Block, about AI-related layoffs. But on top of that, too, keep in mind we did get that major report from Anthropic as well. And within that report from Anthropic, it shouted out that people who are younger are going to be impacted by AI the most. And so I took a look in the BLS report, and what we've seen over the past year is an uptick, or rather a tick just a slight lower, down to about 7.4% compared to what we saw last year for ages 20 to 24 of 8.3%. And so it'll be interesting to see how exactly this all plays out as AI certainly takes a role in the workforce.
Good stuff there, Brooke. Inez, why this report bothers me, top of mind amongst all the concerns that I had with this report, it's jobs slowing down. In fact, we lost jobs. At the same time, gas prices are going up because of the war against Iran. That is not a combination for strong economic growth this spring.
No, and as one of our guests pointed out, this speaks to fears of stagflation. I mean, you are looking at Brent right now that's around $90 a barrel. the longer that this goes, the more the risk that you will see prices that are inflation that goes higher because of these higher energy prices. At some point, there is demand destruction, but I mean, then you are looking at slower growth as well. So this report didn't spoke to these kinds of fears, and the fact that you have AI layered on top of all of this. I mean, this is an industry that up through 2030 is expected to spend trillions of dollars on AI are expected to be spent. And the purpose is to replace human tasks. So you have to think to yourself that, yes, there will be displacement. The question is what will come on the other side of this, on the other end of this. But I mean, corporations' biggest expense right now is labor, human labor. And so all of this money that's being spent on there, this is what is sort of driving some of these fears as well.
Tom, I think Inez nailed it with the stagflation call out. And here's what I'm also concerned about. Why would employers now go out there and aggressively hire this month in April against the backdrop of rising geopolitical uncertainty? Basically, what I'm trying to say is that I don't see a way out of another bad employment report.
Yeah, this is what we don't need right now, right? I think that the economy is not going gangbusters like all of the data may imply, or most of the data may imply. We are not far from all of a sudden a stagnant economy led by a labor market that begins to contract. And now we have even less reason to hire. And all the costs are going to go up in the short term because oil is spiking higher. Brent's over $90 as we're talking right now. And so you're right. I think that this just furthers the paralysis in the labor market, and that is a risk. We have not seen it show up yet in declines in consumer spending or the ISM PMIs, but that can happen very quickly. And again, given the private credit worries we have, given the AI anxiety worries we have, and now the war, if we all of a sudden have to start thinking about a slowing economy, then this market is going to drop, and it's going to be painful.
Yeah, no, it's good stuff, Tom Lee. I want to bring up a clip that we put together. All week we've been talking to top minds in the street, trying to get a sense on where you hide out against a backdrop like this. Take a listen.
I think I get very concerned if you start seeing investors piling into things like staples, which have trading at multiples we haven't seen in 20 years. I think investors need to be less complacent, but more careful about some of the automatic moves in the handbook for when a war starts.
The whole name of the game with the markets is, does oil pass through the Strait of Hormuz? If they don't get through, then you have problems like you saw yesterday, which is inflation, which means no Fed cuts, which means risk to private credit, which means yields blowing out.
Whatever the outside catalyst is, when you have what we call an exogenous variable out there, and war is a super big exogenous variable, meaning it's outside of anyone's control, it's not really gameable by anyone on the inside. It's a time to kind of be happy when you have cash and just, I like to step back and do homework.
Tom, final word to you. What's the safety trade right now?
So go energy, right? Domestic energy, XOP, to a lesser degree, XLE. If oil is going to crash everything, then those stocks are going to do well. So that's your purest play hedge. Other than that, stick defensive. It's lower beta. It'll hold up better.
Good stuff, you all. Have a great weekend. Thank you, Tom, Brooke, and Inez. Straight ahead, my conversation with General David Petraeus. Looking forward to that one. welcome back. You're seeing the markets under a severe amount of selling pressure after that very disappointing jobs report. The read appears to be this. A slow economy into the U.S. attacks on Iran is not exactly a good thing for economic growth comes the spring. All major indices down a lot. The Dow, S&P 500, NASDAQ deeply in the red. Really all sectors in the red as well. It is hard to find the safe haven trade at this precise moment. Now, in my Power Player interview for today, I sat down with General David Petraeus, former director of the CIA, current KKR partner, and chairman of the Global Institute and chairman of KKR Middle East. Petraeus famously led the 2007 to 2008 Iraq troop surge. All right, joining me now is retired General David Petraeus, who, of course, is also the former director of the CIA. General, so great to see you. Thank you for making time for us. I know these are busy days in your world. I just think from an investor standpoint, so many investors are wondering how long these attacks on Iran will continue. From your assessment, we're several days in right now, from your assessment, how long might this continue?
Well, I'm afraid the only way to answer that is to start with the words, it depends. And not just because I'm a former economics professor and that's how you answer every question, but it really does depend. I think there's a number of factors here. One is, how well are we doing against the various target sets that we have? Well, obviously, we've been extraordinarily successful against the leadership targets, Supreme Leader, all these others that were very early on killed. And that does continue. There are still targets in that category. But again, enormous success already there. The effort against the retaliatory means, so we're talking about first and foremost, taking down their air and ballistic missile defenses so that we can use our non-stealthy aircraft, in addition to the stealth fighter bombers, the F-35s that we and the Israelis have, the stealth B-2 bombers. But now you can bring in the B-52s, the B-1s, these huge workhorses that can carry enormous payloads and hammer all. We're talking probably now way over 5,000 individual targets at this point in the campaign, approaching 6,000, I suspect. So that was taken down very quickly. But now it's the retaliatory means. It's the missile launchers. In particular, Israel alone has taken out more than 300 of those. It's the missile stockpiles. We're going after those at a very rapid rate. It's actually the missile manufacturing facilities, because we want to prevent them from being able to reconstitute this again as quickly as they did after the 12-day war, which, by the way, everybody was thinking that Israel was going to go back in anyway, even if they had to do it alone within a month or two, because they were getting so worried about the reconstitution of that program. It's also the drones. We've seen how challenging the drone program has been from Iran. In fact, in some cases, using $2 million interceptors to take down a $20,000 or $30,000 Shahed drone sent by Iran. Those numbers are still fairly high. The missile attack numbers have come way down. And the Central Command commander briefed yesterday, they're down by over 80% at the very least. There's a post I did on LinkedIn today. It shows how they've come down against the UAE in particular. But the drone numbers are still fairly elevated. So that's another target set that we're going after. We want to go after any remnants of the nuclear program. The IAEA, Atomic Energy Agency, said a few days before this there might be a stockpile of 60% enriched uranium that's buried under the rubble of Esfahan in some tunnels. I'm sure we're going to pile drive our way down with the massive ordnance penetrator, the 30,000-pound precision munition that only we have, and only we have the plane that can carry. So that's another one of those that will also be significant here. The regime forces just in general, the Revolutionary Guards Corps, headquarters, bases, depots, a special focus in the Northwest in case the Iranian Kurds want to do some operations up there. That's another one that's important. The naval forces, the president has highlighted this. Central Command has reported way over 20 of their ships have been sunk, including the flagship, which was coming back from some kind of display south of India, and the first submarine kill of a ship with a torpedo since World War II. So all of these. And then there's going to be a question, where are we on the missile math? So this is, how many interceptors do we have left relative to the missiles that they have left? And keep in mind, we don't produce large numbers of these. There's a reason that President Trump is hosting all the industrial leaders today in the White House, and that is, I'm sure, to exhort them to dramatically increase production of Patriot interceptors, THAAD, terminal high altitude area defense interceptors, SM-3s, that's the shipborne version almost of a Patriot. The numbers, look, we only produced 620 Patriot interceptors last year. Think about the hundreds that have been used already. And normally the technique is you use 2 interceptors against each missile. I suspect we're probably already falling off that. We've seen some of the Gulf states voice concern about the number of interceptors they have left relative to what we think is the number of missiles that Iran has left. So that's another factor in there before. I think the 12-day war ended on the 12th day in part because Israel was getting a little uneasy about that particular math. Then there's the big question, is there any opposition force? Does the army break off from the military as opposed to the Revolutionary Guards Corps? Could you see some emerging leader that can galvanize the population that is so outraged at their government for taking a country that has the second largest natural gas reserves in the world, the third largest crude oil reserves, an educated population and an ancient civilization, and running it into a ditch economically at home and getting it isolated abroad? All of these are factors. And of course, also watching who is the new supreme leader. Hasn't been selected yet. There are rumors that it could be Ayatollah Khamenei's son. That would not be good news, I would not think. President Trump wants to have a say in this. I think that's perhaps a bit more aspirational. I'd love to see him have a say.
Sure.
And he's also said there must be unconditional surrender. Well, this is a regime that it'll be surrounded by destruction and death and debris. And there will be a fist come out shaking and saying, we won, we survived. Well, they're going to survive, but the conditions are going to be horrible. So all these different factors will come together. And I suspect the war ends when President Trump decides to end it.
General, let me, I want to get back to that. The markets are very focused on the Strait of Hormuz. The last information I was able to see, there are no ships going through here. That is sending oil prices much higher.
Yes.
What has to happen to get this back open and back open soon?
Well, a lot of this is just voluntary, but they have seen 3 ships hit in some fashion around the Gulf and another one hit off the coast of Kuwait. And this is where drone threats can be particularly challenging. What has to happen is there has to be sufficient confidence that they're not going to be hit as they transit the Gulf and the Strait. And that has not yet been achieved. The president's trying to mitigate this. He announced that we'll escort ships as we did back in the tanker wars of the mid-1980s. The International Development Finance Corporation will underwrite the risk insurance on this. And all the rest of this, we're sinking their ships, going after, again, their retaliatory means. But at the end of the day, it's going to rest on the confidence assessments by leaders of the major shipping companies. Maersk, for example, very early on said they just aren't going to transit the Strait of Hormuz or the Bab el-Mandeb over on the other side where the Houthis have made problems, which goes up into the Suez Canal. So this is a very significant issue. You've watched as even prior to the operation, there was a risk premium that took the price of Brent crude from sort of mid to low 60s up to low 70s. Then we watched in recent days as it went up to the higher 70s. One day it actually went over 80, then fell back to 78. Then it went and it ended at 83. Today, the last time I checked, it's actually approaching $90 a barrel. So in fact, I'll very quickly check again because this is a tab that is always open, and it's interesting to watch, again, the market sentiment on this without question. So that is a big issue. And Brent crude is $89 a barrel, nearly 90. So again, the market is going to have to see a decision by the shipping companies that they're comfortable putting their ships out. Keep in mind, you know well that this is 20% of the world's crude oil, 20% of the world's LNG. It affects mostly Asian markets, but it also affects certain European markets and especially some categories, including aviation fuel, which requires distillates, because this is, again, not just crude oil, it's also distillates and also, of course, LNG. So I think there's a very big focus on what could interdict this. It's the ships that could lay mines in the strait. We've had that before. We rehearsed that when I was Central Command Commander many times, whether go outside in, inside out, whatever it may be. And also, again, the concern about the fast boats that can cause problems, and then the drones, as I said, as well. And I suspect that that is one of the major focus areas of the campaign right now, especially from the Central Command side, as the Israelis go after further regime forces, headquarters, depots, logistics bases, and all the rest of that.
General, one more, if I might. Now, we're only a couple days into the U.S. Attacks on Iran, but how concerned are you that if this continues a few more weeks, we're looking at a sharp economic slowdown in the United States?
I think the U.S. is less affected, except that, curiously, the price of West Texas Intermediate sort of goes up with Brent, even though it's not affected at all. Our production, we can probably even ramp it up. Keeping in mind, we're the largest oil producer by far in the world, somewhere 14 million barrels per day-ish. We're the largest LNG exporter, so we're absolutely self-sufficient when it comes to natural gas. We are actually not self-sufficient when it comes to crude oil because we don't produce enough heavy crude for our refineries, but we get that from secure locations, not from the Gulf. We get it from Canada, Mexico, and now Venezuela once again. So, but it's curious that that does climb. There's a sympathetic effect, if you will, for West Texas, that inexplicably it goes up, as does Brent crude. They're not interchangeable in all respects. One is heavier than the other. So, yeah, that's a concern because as the price goes up, obviously the price of a gallon of gas goes up very quickly. It's surprisingly it shouldn't because these are all futures contracts and they bought that at a much lower rate, but that's the reality. And then it's a factor of production in everything that we make and do and so forth. So it is understandable that there will be concerns as prices do ease up. Affordability is a huge issue in the midterm elections that are coming up. And so this is why President Trump's trying to mitigate this. He said, we'll escort the tankers. We'll underwrite the insurance, as I mentioned. And now he's even allowing India to buy more of Russian crude than was agreed during the tariff negotiations because we don't want to see the price spike further. You may also see a release of the strategic reserves that are held by China, the EU, and even perhaps the United States. But all of these are just reducing how much it would go up. They can't stop it or get it to go down.
General Petraeus, thank you for doing this. I know you do not have a lot of time. You always make time for us here at Yahoo Finance, and I really do appreciate it.
Great to be with you. Thanks very much.
Thank you so much.
Market Catalyst. I'm Julie Hyman. 30 minutes into the U.S. trading day on this Jobs Day, Friday. And of course, the headline here is that we saw a decline of 92,000 jobs last month. That has been rippling its way through the markets as the unemployment rate ticked up to 4.4%. And so we're really seeing a double whammy here today, because it's not just the effect of the jobs report on the markets right now. It's also the effect of much higher oil prices that are raising concerns about inflation once again, because normally you get a bad jobs report that, at least in the eyes of market participants, might raise the chances that the Fed is going to cut rates. But the Fed can't necessarily cut rates if you've got oil prices at $85 a barrel or above. So that's the sort of conundrum where we find ourselves this morning. The Dow is down more than 750 points, about 1.5%. The S&P 500 down nearly that amount. The Nasdaq off about 1.25%. And of course, we continue to watch what's going on in the energy markets very, very closely. Here's crude oil futures. They had been as high as $88 a barrel on WTI. We're coming back down a little bit. Brent crude is above $90 a barrel. That's the international benchmark. And so some of the economics commentary I've been seeing is that, as we start to get closer to the 90s on WTI specifically, that then starts to become more problematic when we're talking about gasoline prices at the pump. Although some folks have talked about that Europe and Asia are going to be more pinched by that than perhaps what's going on here in the United States. Sector-wise, in the S&P 500, everything is down here. Energy's down the least, as you might imagine, with energy prices higher. Financials continuing to take a hit here. Materials, consumer discretionary, obviously a lot of concern centered there about those higher gasoline prices. And healthcare also lower. In healthcare, it bears mentioning that was responsible for some of the weakness that we saw in the jobs number. Healthcare has been an area of strength for just months and months now, but there was a strike at Kaiser, and that was responsible for some of the holdback in hiring last month. So that's kind of a snapshot of what's going on in markets. Something else that we are watching closely here this morning, if I can find the retail screen here on our various heat maps. I'll leave it for now, but I'll tell you the Gap shares are falling. That retailer did miss expectations for the fourth quarter. Comparable sales for both Old Navy and Athleta brands come up short. There were some big areas of strength in some of the other brands, however, and that's where I find Yahoo Finance executive editor Brian Sozzi and the CEO of the Gap, Richard Dixon. Brian, take it away.
All right, thanks, Julie. Richard, good to see you. Look, it's been a week at the ranch. It's been a tough day for the markets. I think we need some positive, uplifting news here, at least going into the week. And to that end, let's start on Gap. 9 straight quarters of positive sales at the Gap. I put this post out last night on my X account, calling this turnaround at Gap stunning. And now I'm hearing you saying you were going back into growth mode with this division. What does growth mode look like at the Gap brand in particular this year?
All right, Brian, thank you. I'm all in on good news. We did deliver a successful fourth quarter, and that's marking another year of really meaningful progress for Gap Inc., which you've been watching the past couple of years. We achieved our second consecutive year of top-line growth, and 8th consecutive quarter of positive comparable sales. We noted, the comps were up 3% in the quarter, meeting our expectations. Old Navy up 3% as well, largest specialty apparel brand in the U.S. Gap up 7%. That's on top of 7% last year also. Banana Republic, third quarter in a row of positive comps, up 4%. So we're winning across all income cohorts. Also important to note, this was one of our highest gross margin years in the last 25 years. We've improved our balance sheet. We're ending with $3 billion in cash. So this is a progress point for us and a pivotal point in our transformation. I do want to double click on the brand Gap. As you said, it is so exciting to see our namesake brand building on success literally quarter after quarter. The fourth quarter marked the brand's 9th consecutive quarter of positive comps. We've been consistently gaining market share. It's through great product assortments, great marketing, and in-store execution. Team has done a brilliant job, literally driving a multi-generational appeal. And ultimately, we're watching all income cohorts appeal to Gap. More high-income consumers are choosing Gap. Categories, fleece, logo, denim, sleepwear, all doing incredibly well. So we can be, very confident in saying that Gap is firmly back in the cultural conversation. It's a true pop culture brand, product resonance from red carpets to surprising collaborations, and I can guarantee you a lot more exciting moments to come in 26.
If I was sitting here 15 years ago saying, I'm going to talk to the CEO of Gap, and they're going to be putting more CapEx behind the Gap brand, I'd be like, well, I don't know about all that. But Richard, you are. This year you teased a new store format for Gap. What does that store look like? Because you also teased a bigger push into accessories finally, and a bigger push into beauty. Like, these are your three big growth levers for Gap this year. Like, how does that impact the business, and when do all these things hit?
Yeah, well, first let's talk about beauty, because I think, in the context of what we shared in relation to our strategies of extending our brands, first we're going to drive continuous improvement on our core apparel business. So the recognition that we've got a good flywheel going, better product, better storytelling, better in-store execution, that will continue. And then we're extending our brand into accelerators such as beauty, accessories, and we mentioned fashiontainment. Beauty is one of the fastest growing, most resilient retail categories in the US, and our customer insights are reinforcing strong demand for the category. Now, when you look at other fashion and apparel retailers that have a beauty business, the category represents anywhere from 5% at a low to 20% of their sales. And when you think about those percentages against our base business, it really does highlight the meaningful potential that this category can represent within our business over time. It's also, I think, important to note, we do have a beauty business. It's just underdeveloped. And based on our feedback from consumers, we know the potential of this category is enormous. So we announced plans for our expansion in 2025. We've got a phased introduction of this, starting with Old Navy. You're going to see Gap relaunching its fragrance later this year. And we'll continue to build this category out, along with accessories, fashiontainment, and as you mentioned, new store rollouts. We renovated and have some remodels that we've been testing over the last couple of years. Flatiron in New York City, Chestnut here in our hometown in San Francisco, and some other areas. These stores are outperforming our existing fleet, giving us the confidence so we can start to really accelerate these new store remodels, reformats, and even new doors in the coming future. So a great position for us to be in, and one that we believe is a pivotal point in our transformation.
Richard, you mentioned on the call last night $150 million in cost savings this year. And look, I said at the top of the show that I think AI is really starting to impact many jobs in this country. We, of course, saw that news from Block. Like, out of these savings, how much does it reflect the company leaning in on AI and rethinking its workflows?
Our capital to go after the accelerants and ultimately reinvest in the core of our business. And technology is a key part of that. I mean, we do pride ourselves on being a human-centered, digitally enabled company. And our AI investment approach is very disciplined. With this foundation in place in the context of our Office of AI, we're really focused on three strategic layers. The first is reinvent. AI is helping us create new tools, new ways of working. It's changing literally how we design products. The second one is optimization, enhancing existing systems and experiences with real-time insights. This is impacting how we plan our business, even how we price our product. And the third is enable, empowering every member of our team with AI tools and the training to move faster and ultimately think bigger. So we're focused on areas where we believe AI can meaningfully reduce customer friction, increase predictability across product to market, and ultimately unlock enterprise productivity. There's lots more that we could share in the context of what we're doing. Our headquarters are in the Bay Area, so we continue to work with our neighbors, modernizing our organization, partnerships with Google Cloud, many exciting opportunities to drive innovation across our business, and obviously we'll keep you updated on all of that as things move forward.
Richard, of course, you and I, we can't control the stock market. We can't control what's happening over there in the Middle East, but what you can control as the CEO of Gap is what you sell your products for. Now, how concerned are you this spring is going to be really a spring selling season for Gap and retail of discounts because consumers are more pressured, their gas prices are higher, their bills in other areas are higher because of what's happening in the Middle East. Like, what levers are you prepared to fill?
Well, look, we're always living in a competitive environment, and it's our job to offer the best product, best price, best quality to break through, if you will, from the competition and grow our business. And we have been. Obviously, I mentioned 2 years of consecutive comps. It's also been market share growth, which really indicates that we are winning in the competitive landscape. Now, as you know, it is a promotional and highly competitive landscape, and promotion level is very much dependent on the competitive environment that we're operating in. It's our job to deliver on our customers' needs and wants. Our top priority is to execute the product and marketing to drive interest and demand. In the fourth quarter, we were actually less promotional year over year, and we drove greater impact and excitement. It's a strong proof point of the strength of our brands and our marketing effectiveness. So as we move into 2026, of course, we'll continue to be strategic about our use of promotions. We are obviously aiming to compete, and any promotional strategy that we currently have is already built into the gross margin outlook that we provided yesterday.
On Athleta, Richard, look, Lululemon has been sucking wind. I don't even think they have a real CEO running that company. They're being attacked by activist investor. Why isn't Athleta doing better, and when will that business turn?
We're disappointed in our Athleta trend, and as I've shared very transparently, our prior efforts over-rotated to attract a new consumer, and the product that we offered just lacked resonance. Now, we brought in Maggie Gauger. She's fantastic, and under Maggie's leadership, she's only been there for a few months. The team has been re-architecting the assortment, and most importantly, it's based on consumer insights. We're bringing back customer favorites, but we're building those items into key franchises. You know, Brian, you know this. This is a category that thrives on innovation, and our team is developing a really exciting pipeline of innovative products. We believe in this brand. Despite our challenges, we've maintained authority in the category. We're the number 5 brand in the women's active space, and we've held that ranking. We've got net sales of over $1 billion, so it's a meaningful brand in our portfolio, and it's profitable. Athleta, it holds a distinctive position in the marketplace. It's a women's-only brand. It's a B Corp brand. These are distinctive attributes, and we need to do a better job personifying this brand going forward. 2026 is about rebuilding it for growth. Progress will take time, but I'm confident in the brand and the path going forward.
Richard, let's get some men's stuff in there. Any compression stuff that I could put on my body and make me look buffer, I'm all for, dude. Just sign me up, man.
We'll make it specifically for you, Brian.
All right, that's all I can ask. Richard Dixon, good to see you. Have a good weekend. We'll talk to you soon.
Thank you so much.
All right, Julie, back to you.
I'm a fan of the Athleta swimwear, for what it's worth. Which is probably
it means a lot, Julie.
Yeah.
It means a lot.
All right.
It's news you can use.
Let's get back to the labor market news right now because it's showing signs of weakness. U.S. employers unexpectedly cut jobs in February. The unemployment rate rose after what was a strong start to the year. For more on what this means for the Federal Reserve, we're joined by Yahoo Finance's Jennifer Schonberger. Hi, Jen.
Hey, Julie. Definitely not as fun as the previous conversation talking about fashion.
No, definitely not. But, important nonetheless.
Yes. I mean, look, Julie, I think this report was definitely a surprise for all of us, and it really puts the Fed between a rock and a hard place because I think the thought within the central bank was, hey, the labor market is stabilizing given the 3 rate cuts that we did at the tail end of 2025. And then today we see a negative print to the tune of negative 92,000 down on payrolls, the unemployment rate ticking up to 4.4%, revisions in the prior months, and the labor force participation rate dropping. Now, granted, this was a bit of a muddy report because there was a strike in the healthcare sector, Kaiser Permanente workers, and we know that the lion's share of job growth has been coming from the healthcare sector, so that was a big ding. We also saw winter storms. So there is the chance that this is a one-off, but at the same time, the prior months, as I mentioned, were revised downwards. Now, the Fed is also dealing with a global price shock because of the war in the Middle East. And so absent any inflation risk, they may have leaned towards a rate cut. But now with inflation still above the Fed's 2% goal for 5 years running, and what's going on with the Middle East and the impact on oil, this likely to keep them on hold in the near term.
Right. I mean, it's really interesting this morning. You know, we did initially see yields come down, which is what you would expect after a jobs report like this. But then they came back up again because you've got the oil prices where they are today. So it's been a really unusual sort of market reaction day in that sense to a jobs report that otherwise would maybe indicate that cuts are coming. Maybe we got to move up the timeline, but that's, you know, that doesn't seem to be the case. You know, so what do we need to be paying attention to in terms of the headlines coming out of the White House on Iran and what the implications are then for the markets?
Yeah, I think the biggest question is how long is this going to last? Obviously, the president laid out that baseline scenario of 4 to 5 weeks, but then we've also heard the notion of 100 days. It's very unclear at this point, and the president has also made clear that he is not going to stop until the job is done. And so I think when we look at the Fed and how they're looking at this conflict and the impact on oil and thus inflation, they do see risk in the near-term outlook for inflation. But the question is, how long does this conflict last? And does it create a persistent situation for inflation? And that's what we're hearing from many Fed officials. That's what New York Fed President John Williams spoke to me about this week. It also raises uncertainty about the economic outlook because you could have implications globally that could spill back over into the U.S.
Yeah. Well, we'll just have to wait and see how it all plays out, Jen. Thanks so much. Appreciate it. Well, let's check in on where prediction markets are pricing in Fed cuts this year. The market is somewhat split between one cut or two cuts at the moment. So we'll see, you know, this was as of a little bit after the jobs report. So we'll see if those numbers move around a little bit more. And you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub. It is powered by Polymarket. Coming up, the top analyst calls on Wall Street. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ this morning here in Times Square. Let's break down some of today's top analyst calls on Wall Street. We're watching shares of Marvell Technology, Trade Desk, and Netflix this morning. First up, Marvell Technology, both Benchmark and Bank of America raised their rating on the stock to a buy from a hold. Now, this comes after the company raised its 2027 outlook based on stronger than expected growth in its data center revenue. It now expects overall revenue to jump 30% year over year for this year. Now, the analyst at Bank of America likes Marvell's broad portfolio and has greater conviction around its solid leverage of AI optical connectivity and success in its upcoming custom AI chip business. The Street mostly bullish on this one. There are 41 buy ratings, only 10 holds, and no sell ratings on the Street right now. Next up, let's take a look at Trade Desk. Wedbush downgraded the stock, saying it does not believe the incremental value of the rumored deal with OpenAI warrants the current share price. The analyst said that while it got attention, the fundamental math suggests that the immediate impact through 2027 will be immaterial. The Street mixed on this one with 21 buys, 18 holds, and 4 sells. Lastly, let's take a look at a company we've been talking a lot about, the streaming giant Netflix. CFRA upgraded the stock to buy, citing its global advantage in video streaming compared to other U.S. network providers. The analyst went on to say that key drivers include membership growth that is, pricing power, and ad revenue increasing in the near term. There are 47 buys, 15 holds, and 1 sell on the Street. Netflix well-liked. Keep right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the trading session.
Ongoing conflict in the Middle East is making portfolio management even tougher. For more on how to manage your assets at times of uncertainty, let's bring in John Shrewsbury, Managing Principal at Gen Wealth Financial Advisor, for this week's FA Corner, brought to you by Capital Group. John, it's good to see you. I would imagine you're getting some calls from clients as all this is going on, as we're watching oil push up towards $90 a barrel. But I know when you're looking at sort of the playbook for what to do here, maybe people can consider, first of all, not doing a heck of a lot as all of this is going on.
Yeah, we've seen this movie before. This is just kind of a replay of the crisis du jour, whatever may be going on. What I would say is that the real threat, I think, in the landscape that we're in right now is not so much what's happening in the markets, but I think that there's a real threat to people's career. Obviously, the job loss report today coming out, the news yesterday that Morgan Stanley laid off 2,500 people, followed behind what Block did in their layoff of 4,000 people. What that says to us is that there is a real change going on in the workforce, labor force, and a lot of that being driven by AI. And we think that people have to think about how they elevate themselves above that and reinvent themselves, because that's really the long-term threat to most people. It's not what is happening over the weekend or currently in the Middle East or in the markets. It really is what's happening to their purchasing power and their income stream that they would have from their jobs. And so it is a little bit of a different environment in that regard. But obviously we're watching things in the Middle East, and the oil thing as it approaches 90, that becomes a little bit of a red flag for us to pay attention to, because at $90 a barrel, that begins to change a lot of equations across the economy. But these things have a way of passing and being more sporadic impact than it is for a long-term investor.
So if an investor is watching this volatility in the short term, as you said, as oil prices climb up a little bit higher, maybe that, I mean, does that trigger, it might trigger some more concerns on consumer spending. Does it trigger changes in the portfolio that you want to consider making at that point?
I really think that it is highly dependent upon what the objective of the individual investor is. If we're talking about their long-term retirement portfolio, this is actually not a bad thing, because if they are putting money into their 401k or they're adding to their IRA on a regular basis, the volatility is actually their friend, because they can buy shares at a lot cheaper prices than they maybe could 6 months ago or 3 months ago, or whatever the case may be. So that volatility and time really work in their favor. Now, if you're a short-term trader or something like that, then yeah, these things are concerning and make you pull your hair out. But we don't deal with a lot of those folks. We live in the middle of the country. We live where people are very long-term focused on their retirement goals and things of that nature. Not a lot of day traders in the middle of the country that we work with, and those folks are the ones that are really, wringing their hands and paying attention these days. The long-term investors are not calling us. They're really highly diversified, and we believe that this is really where diversification is finally having its moment. If you look around, the S&P 500 is getting clobbered with a lot of this, but across the landscape of all the diversified investments out there, we're still in a pretty good situation. So we think that diversification really does save the day if you are a long-term investor, but short-term investors are definitely taking it on the chin.
And as for diversification, there's people maybe reach for havens at times like this. How do you think about how to be allocated to those traditional havens?
Yeah, we're not making big bets into any havens by any stretch of the imagination. Obviously, bonds have a place in diversification, and I would say that a sliver of gold actually has a good place in diversification. But gold is one of those things that's really interesting. People really tout it as a haven for volatility, but gold can be volatile as well. There can be big swings in the price of gold simply because of the speculative nature of gold. There is no intrinsic value in gold. It really is worth what somebody's willing to pay for it. And so we don't make those big bets like that. Gold can be part of a well-diversified portfolio. Bonds can be a well-diversifier, a good diversifier. Alternative investments, private equity, things of that nature that are not jostled by the day-to-day events in the stock market. They're more driven by earnings and things of that nature. Those things are things that we try to help people understand, that a well-diversified portfolio has many holdings, not just, hey, let's put it all in the S&P 500 or large cap growth stocks that have historically been very good place to be. We think that is evolving and changing over time.
Gotcha. John, good to see you. Thanks so much.
Thank you.
That was FA Corner, brought to you by Capital Group. Coming up, we're going to bring you a full half hour dedicated to tax season. We'll break down the key deadlines to know what your tax return will look like and how to get ahead of next year's taxes. Don't go anywhere. Tax season's in full swing, and we want to help you get prepared with our tax season playbook. The Internal Revenue Service expects Americans to file 164 million tax returns this year. Here's some key dates to be aware of. For the vast majority of taxpayers, returns are due on April 15th unless it lands on a weekend or holiday. If you live outside the U.S. or are serving abroad in the military, you have 2 additional months to file your individual income taxes without penalty on or around June 15th. While you automatically receive this extension so long as you indicate on your return that you're based abroad, you will still have to pay interest on any uncollected taxes if not filed by the original due date. And if you need more time to file, you can ask for an extension. That gives you until October 15th to file your return. For those who live in the U.S., you'll still need to send the IRS Form 4868, application for automatic extension of time to file U.S. individual income tax return. You can do all this via your online tax preparation service, an accountant, by mail, or through the federal government's free file program. One key detail, an extension of time to file doesn't mean an extension of time to pay. So you got to make sure you pay any owed taxes, estimated taxes, at least by the original due date, or you could face penalties. This year, the IRS has granted automatic extensions on some deadlines for taxpayers affected by natural disasters in Louisiana and Montana. And as for when you'll receive your return, that depends, especially if you have a more complicated tax situation. But typically, you can expect it about 2 to 3 weeks after your filing. Well, the Republican tax bill passed in 2025, also known as the One Big Beautiful Bill, is in effect. While the process of filing your taxes, of course, that doesn't change. Some of the details could look different here. According to the Tax Foundation, the biggest changes represent a tax cut of $129 billion. Let's talk about what a little sliver of it could mean for you. Here to explain some of the biggest changes and how that affects you, Mark Stieber, Jackson Hewitt Tax Service Chief Tax Information Officer, and Garrett Watson, Tax Foundation Senior Policy Analyst and Modeling Manager. So, Mark, let's get to you first here. What, sort of high level, what is the maybe biggest change that people are going to need to be aware of as they're filing?
Yeah, biggest change really is the change that impacts you, and each and every individual are different. So those with tips, that big new $25,000 potential deduction, that's big to them. If on the other hand, you're an overtime qualified wage earner, that new $12,500 potential deduction for overtime might make bigger sense on your tax return. Then again, the senior deduction. If you're just 65 or older, you can qualify for a new $6,000 per person deduction. And of course, if you bought a car and you financed it in 25 and it was final assembled, that new potential $10,000 deduction probably looks good to you. On the other hand, they expanded the state and local tax break, which of course was unlimited in years past. Then they limited it to $10,000. Now that's been raised up to $40,000. So if you're in one of those states with high property tax and high income tax, and you itemize, that new $40,000 threshold might make sense to you. And then you put all those on the side. If none of that affected you, but you had a big life change, you moved to a new state, or you started a new job, you started a side hustle, you started trading in cryptocurrency, those rules might make some impact. So it really is taxpayer specific on what is really important. But there's a lot to watch this year. It's probably the biggest year that I've seen in my career of tax law change, life change as we continue to emerge from the pandemic. It's really quite an opportunity year to get a bigger refund.
Yeah, so Garrett, obviously there's a lot to parse through here. But sort of the policy changes and that we have been talking about, and then how that might trickle down, understanding it's going to be different for every person. From a policy perspective, what do you think is the biggest change that could then translate into a big change on these returns?
So I think Mark covered a lot of the major items we're going to see. Of course, these major new tax deductions are going to be a very large source of elevated refunds in the tax season, according to our estimates. It's a big chunk of that new $129 billion that folks are going to be getting in tax cuts in 2025. And that'll be paired along with other broader changes. For example, a slight increase in the standard deduction that most Americans take when they file their taxes, along with a slight increase in the value of the child tax credit for families with children, going from a maximum value of $2,000 to $2,200 this year, which really can add up if you're a family with multiple children. children. But I think it is an important point that Mark said, that there's going to be a lot of variation here for folks. An average of about $750 to $1,000 increase in refunds is just that, an average. We might see a lot of variation here where, with these policy changes, very targeted tax cuts, some folks with overtime or tips may see very large increases in their refunds if it affects them. Others who aren't in those targeted tax changes may see smaller increases in their refunds. So really important to take a look at how these changes may impact our tax situation and work closely with a professional to see how this might impact you as we get closer to the deadline.
Something else that I know there's a change on is the car loan interest. So Mark, what do people need to be aware of there?
Well, a couple of things. One, it's not automatic. I'm surprised at how many taxpayers just think if you file your tax return, like the stimulus payments, you're just going to get these tax breaks. You have to actually put them on your tax return. And an important point to also note is you do not have to itemize for any of these big four. The overtime, the tips, the automobile loan interest deduction, and even the senior deduction. They go in a separate place, new form, new line. Now, the automobile interest, it's really an important item because if you take a loan out to buy a car, and tens of millions of people do that every year, then you can take the auto loan interest as a deduction. And again, I emphasize you do not have to itemize. As was pointed out earlier, a lot of people don't itemize today. They take that large standard deduction. Well, these new benefits don't have any consequence on that. So if you bought a car in 2025 and you financed it, which many do, watch for that auto loan. The interest can be tax deductible regardless of whether you itemize. Now, there are some, requirements. It has to be final assembled in the United States, and there's some income limitations. If you're high income, they phase out because a lot of these benefits don't inure over to high income earners. But if you're just a regular person, bought a car, financed it, and it was final assembled here, and that's a lot of cars, you've got a brand new tax break up to $10,000. And if you're in a 30% tax bracket, that's another $3,000 of tax refund potential, and those numbers are pretty big.
Garrett, talk me through, speaking of big numbers, talk me through the SALT cap increase and who that could affect.
So prior to this law, SALT was capped at $10,000 for everyone, as Mark had mentioned, and it was increased up to $40,000, which is a pretty dramatic increase in the value of that deduction. Still not unlimited, but that will provide a lot of relief for folks who, in higher cost of living, higher tax locations, were bumping into that limitation, and that's going to mechanically reduce the amount of taxable income and therefore the amount of tax liability they're paying. Though worth noting, of course, this is mostly going to accrue to higher earners who are itemizing, who are exceeding that prior limitation. And that increased SALT deduction will be in place over the next few years, though we will see by 2029 a snapping back of that deduction to $10,000. So definitely a future policy debate to be had about the future of that deduction. But folks will see that relief who are itemizing taking that this year.
Guys, thanks so much. Garrett, thank you very much. Mark, you're going to stick with me for a little bit more in just a moment. Coming up, we're going to answer what to do in some less common tax situations in our rapid fire round. Don't go anywhere. According to the IRS, about 90% of taxpayers take the standard deduction on their taxes each year rather than itemizing each expense. But there are some less common situations that could be confusing. Still with me is Mark Stieber, Jackson Jewett Tax Service Chief Tax Information Officer. We talked about some of them just a few moments ago, but there are some also that are even less common. So let's run through those here. First of all, we have seen a huge rise in prediction markets, right, as well as online gambling. What are the implications for people who are filing, who have either made or I guess lost money doing that?
Yeah, gaming, especially with the proliferation of the online gaming, many states allowing it now, the development of apps, you can bet on just about anything. And the rules can be very complicated, in particular with the rule change that's taking place or supposed to take place for this year. The one thing that I find most misunderstood about gaming are two things, really. Number one is there's no de minimis. If you win $1, that's taxable. There's no $600 rule. There's no it has to be a professional rule. There's no casino rule. There's a if you have income rule. And if you have income, even the pool in the office for March Madness, and you win, technically that's taxable. Now, where you put it on there, whether the IRS knows about it, that's a separate issue, but it's taxable. The second and more misunderstood rule regarding gaming is that you get to net everything, which is not true. The rules do not allow wins and losses. So even if you come out kind of good at the end of the year or kind of bad at the end of the year, you have to put all gross winnings on page 1, and then it really gets murky, even under the old rules, on where you take a deduction, if you take a deduction. And that has changed now to even limit your deductions up to 90%. And so again, if you've got gaming, more importantly, if you've got significant gaming, you really need to understand the rules, and you need to engage some help to make sure you don't cheat yourself, and more importantly, put yourself at risk.
And just to be clear, this goes for the prediction markets also, the same rules, as well as they fall in the same bucket?
If you have income, I'll put it all in the same bucket. Now, gaming is different, in the fact that you may get a W-2G gaming proceeds, and there's some very restrictive requirements on when the casino or when the platform or when the house needs to report that. But if you have income, it's income, no matter whether it's a side lemonade stand or a hobby or gaming or prediction markets. Now, if you go gaming officially, again, depending on whether you're playing slots or craps or blackjack or betting on a parlay with sports betting, then the rules get a little complicated on the reporting requirement of the platform, not on whether or not you have income. That's simple. Got income, happy day, income.
Okay, a different kind of income from crypto. Does that work differently if you have crypto-related gains or losses?
Well, on the one hand, if you have income, it works the same.
Yeah.
There's no, I only had a little income. Now, there are some rules that allow offsets with capital losses and short-term and long-term. But if you have income, you have a consideration. If you're just buying and investing and you do not sell, that's a different animal, and that's that question on the tax return. Now, as to where you put it, totally different area. If you have digital, accounts, crypto, and all of those types of activities, it's still considered an equity. It's still considered kind of like a stock. It goes in a separate section of the tax return as opposed to gaming income. And the rules are equally convoluted on when you have income, when you have splits, when you have forks, when you have all those other things. And a lot of people think, well, it's just a hobby and they don't report it. Well, starting this year, there's the new 1099 DA for digital assets, which means now if you hit a certain threshold, they're going to report it to you and they're going to report it to the IRS. And that rule changes again in 26. So if you've got digital assets in your portfolio, you need to pay particular attention, because that $2 trillion industry is of a great deal of interest to the IRS, especially with non-compliance.
Yes, indeed. All right, and finally, just quickly, student loans. What do people need to be aware of there?
Big deduction if you've got student loan payments. I'll simply say if you've got a tax deduction, you don't want to leave that off, and it's not automatic. And it gets a little bit complicated on who the debt's name is and who's making the payments. Suffice to say, if you've got student debt, make sure you don't overlook that $2,500 deduction. It's a pretty sweet nugget. Now, another thing to watch out for if you have student debt, and this was scheduled, but then it got suspended, but it'll probably be back soon, is the offset to any type of tax refund that you might have if you're in arrears on your student debt. That was supposed to start this year in 25 and 26. Now they've suspended it a while, but for those unpaid debts on student loans, if you're due a big tax refund from other activity in the near future, they may try to confiscate that. So it's really important to pay attention to both your student loan and your tax profile.
Ooh, all right, a lot to take in here, Mark. Thank you so much. Really appreciate it.
Good day. Go get that money.
All right, let's take in some more now. Let's talk about retirees because there is still time to save on 2025 and their tax bill. It's even a good time to start planning ahead for next year for them. Yahoo Finance senior columnist Carrie Hannon is joining me now. Carrie, it's great to see you. Let's start with some tips for retirees this year.
Thanks, Julie. Great to be here. Number one, if you had earned income in 2025, make sure you take an individual retirement account contribution if you qualify. This will really help, lop off some from your tax bill. And a lot of people, think, oh, I'm retired, but you may have been consulting, doing part-time work of some kind. So really pay attention to taking that deduction. If you're still in a high deductible health insurance plan and you haven't started Medicare yet, by all means, make a contribution to your health savings account. It's not a huge amount of money, but anything you can set aside in that is going to go in tax-free. It's going to grow tax-free, and you could take it out for qualified medical expenses at any time in the future, tax-free as well. So I think those are three important first steps. And then it gets a little tricky here, Julie. You need to run the numbers on whether you want to take that standard deduction or to itemize your deductions. And so, those numbers, I think the standard deduction is around $31,500 for couples this year, perhaps. You might double check that, but so a lot of people will fall under that category. But the fact is, you might have medical expenses, you might have charitable deductions, you might have mortgage deduction. Some of these things can push you up over that standard deduction and state and local taxes for sure. So really pay attention to what's the best deal for you in terms of that deduction. And, I think it's in many areas around the country, there's specific tax breaks depending on your age. I know in Washington, D.C., there's a lop off on your property taxes if you're over 65. So take a look at what you might have that's just special to where you live. And then let's look at what you might have going on for next year. So you can start looking right now. If you started taking required minimum distributions, if you turned 73 in 2025, also you're going to need to take that first RMD by April 1st of this year. But if you're turning 73 in 2026, pay attention because you might want to take that first RMD this year so that you don't get hit with two RMDs for next year.
Is there anything else you should be doing? I mean, I know it's early, but is there anything else that people need to be aware of this year for when they're filing this year's taxes next year?
I know you want to say, "Oh my gosh, I just finished this year's," or "I'm just." But okay, let's roll our hands together a bit. If you try to take a stab at how much you might have in income coming in, and this can be from all different sources, income from investments and so forth, your RMDs, all that. What tax bracket might you fall into for the 2026 tax year? If you're in a fairly low tax bracket, which is quite possible, you might consider doing a Roth conversion. And I know you talk about this, Julie, with others, but the fact is the Roth conversion, you're taking the money out of your tax deferred retirement accounts, you're rolling it into an IRA, a Roth IRA, and that means it's taxable income to you. So that's going to be taxed, but moving forward, of course, it will not be. So it's a great strategy if you think you're going to be in a low income bracket for 2026, to really sit down with your tax accountant. You don't have to do this alone. Your tax accountant, your financial advisor, and do that. I'm a big fan of the Roth, so if that's something that works for you, do it. You might consider taking your required minimum distributions, as I started to talk about. If you're turning 73 in 2026, you might want to take that first distribution by December 31st of this year, so you don't get hit with two next year, which really will bump up your taxable income. There's also, qualified charitable distributions, which is something that's a pretty interesting tax technique that people who are charitably inclined should look into. There's some nuances around that, but it can provide a very interesting tax break as well for you. And again, there's also the higher state and local tax deduction. It's really been bumped up, and if you live in it's for everyone, not just retirees, but if you live in a state that really taxes these, like New York, New Jersey, California, this can be a really great, you have to itemize for this, but do take a look at that for tax year 2026.
Carrie, thanks so much. Appreciate it.
Thanks, Julie.
Coming up, we're going to break down the changes to expect when filing your 2026 taxes and how you can get ahead. Stay with us. Talked a little bit with Carrie about what retirees need to do this year to get ready for next year's taxes. Let's broaden it out to everybody else and talk to Andrew Gordon Law Partner, tax attorney, and CPA, about what everybody needs to be thinking about this year to get ready for the next filing season. So what do we do, first of all? Once we're done filing taxes this time around, like you think people should do sort of a tax checkup. What does that entail?
Yeah, so if you've already filed your tax return, first of all, you don't want to file too quickly. We had a client just last week that filed their tax return, was so excited that everything was done, and then this week got a K-1, and now they've got to amend their return. So one of the first things you want to make sure you do if you've already filed is make sure you have all of your forms. But as we go into next year and we think about the tax season, there's a few key things that you should do to make sure that you're ahead. The first is, now that we're approaching the middle of the year, 2026, crazy how time flies, run a mid-year tax checkup. Identify your withholding and look at your paycheck and see if you're actually up to your tax rate. For a lot of people, you received a large refund at the end of last year or as you're filing your taxes this year. Mid-year is a great time to check, make sure that you're withholding enough, not too much. Another great tip is to get your documents organized. Year over year, we've got clients that the last week, right before the deadline, they're rushing to get everything together. And what they're doing is they're leaving money on the table. If you don't have your records ready and you're not organized, you're most likely going to miss deductions. You're going to miss tax forms. It's going to make things more complicated, more expensive. The last thing that you should do is run scenarios for big changes in your lifestyle, in any life event that has happened. If you received equity compensation, a bonus, or even if you've now been trading crypto or investing in prediction markets, you should account for those scenarios, make sure that you're paying your estimates, have that withholding in, because at the end of the year, it's gonna come and it's gonna hit you with additional taxes.
Andrew, I have this picture in my head of people showing up at their tax attorney's office with a shoebox full of papers. Does that kind of thing still happen?
Oh, it still happens, but now it's in the digital way, where it's just a folder of miscellaneous files, PDFs, Word documents. And so a great tip is to organize your folders. Have a folder for your income items. Have a folder for deductions, things like charity. And have another folder for miscellaneous items that you're not sure. But the more that you could be organized, the less time it'll take to file your taxes. And again, the more that you'll save.
What about for people who are independent contractors, in the here and now, what do they need to do to get that organization in place for next year?
Yeah, we work with independent contractors all the time that, first of all, aren't aware that they have to withhold and pay their own taxes. On a W-2, your employer takes those taxes out of your paycheck. But independent contractors, you're responsible for estimating, calculating, sending in those payments, in fact, quarterly. So if you're an independent contractor, now's a good time to start already estimating what your income, what your expenses are for the year. And always stay organized. Use a bookkeeping system. Don't do all your bookkeeping at the end of the year. Do it gradually throughout the year.
All right, Andrew, thank you so much. Really appreciate it.
Great being here. Thank you.
And that's it for our special The Tax Season Playbook. I'm Julie Hyman. Thanks so much for watching. More Yahoo Finance is coming up.